Hi there, tax-lazy friends. We'll love you more if you subscribe to our channel, email your queries to fast@taxlazy.com, and visit us at taxlazy.com.planning to set up your business in GCC. Well, let's start from the lowest tax country there is, that is, United Arab Emirates, which, in addition to 5% VAT, has 3 corporate tax regimes. First, the default normal tax regime has granted a zero rating slab of USD 100,000, that is, 375,000 dirhams of taxable income, and then applied corporate tax on the taxable income over and above that at the rate of 9%. This is to support the SME sector, which is already subject to not only VAT, but also hefty non-tax levies, such as corporate licensing fees, workforce visa fees, and a significantly high cost of living due to exorbitant real estate, utilities, telecommunication, and transportation costs. The second UAE corporate tax regime is the qualifying free zone person regime, which applies zero rate of tax on those companies which are registered in free zones and earning qualifying income. The third UAE corporate tax regime is global minimum tax regime, which aims to tax UAE operations of a multinational enterprises with annual global revenues above 750 million euros at a rate of 15%. The UAE became a member of the OECD Inclusive Framework in 2018 and has endeavored to uphold the commitment to implement its recommendations. Introducing corporate tax was also a part of the same endeavor, and as soon as the law was enacted, the UAE did not take long to implement the recommendations of implementing global minimum tax under BEPS Pillar 2.0. When seen in comparison with the UAE, the corporate tax rates in GCC countries are Saudi Arabia 20%, Oman 15%, Kuwait 15%, and Qatar 10%, thus making the UAE the lowest tax rate jurisdiction in the GCC. Bahrain has yet to introduce corporate tax. UAE has double tax agreements only with Saudi Arabia and Kuwait amongst the GCC countries. A double tax agreement, or DTA, is superior to the corporate tax laws of the two countries entering into that DTA. Let's compare the highest and the lowest tax countries of GCC, that is, Saudi Arabia and UAE. Under the double tax agreement between UAE and Saudi Arabia, certain advantages such as certain exemptions from deduction of withholding tax or a lower rate of withholding tax deduction have been provided to UAE companies. This huge gap in tax rates and existence of a double tax agreement has created a tax arbitrage opportunity between the two countries. Tax arbitrage means shifting part of the profit from a high-tax country to a low-tax country so that it is taxed at a lower rate. For example, imagine you had set up a software development company in Saudi Arabia and earned taxable income of $1.1 million for a year. Ignoring the zero slab, this will be taxed at 20%. That is, you would need to pay $220,000 to Zatka, the tax authority of KSA. Now think of moving all of your software engineers, admin, and finance staff to UAE, leaving only marketing staff in Saudi Arabia. Let's say the UAE entity also enters into an agreement with the Saudi Arabia entity to provide professional indemnity insurance in case a project goes bad. This would mean that not only all the back-end work is being done from UAE entity, but also all the business risk is being assumed by the UAE entity. Because when the Saudi Arabian entity wins a software project, the UAE entity will manage and assume the risk end to end. The UAE entity will invoice the Saudi Arabian entity for the project at an arm's length price and earn a net profit of $1 million taxed in UAE at the rate of 9%. That is, the Federal Tax Authority of UAE will get only $90,000. Saudi Arabian entity will probably only add 10% markup on the price charged by the UAE entity, invoice it to the end customer, and earn only $100,000 of net profit and pay 20% tax on it. That is $20,000 only. Altogether, both entities paid $90,000 in UAE and $20,000 in Saudi Arabia. That is $110,000 in total. Compare that with the original corporate tax of $220,000, which the Saudi Arabian entity would have had to pay if you had not formed a UAE back office and shifted all the operations to the UAE. But wait, Saudi Arabia still has a trump card up its sleeve called the Regional Headquarter Regime, which aims to attract multinational companies MNCs, to establish their regional headquarters in the KSA. KSA government announced its intention to cease contracting with companies that do not have their RHQ situated in KSA. Under RHQ regime, a 30 years tax incentive has been proposed for MNCs with RHQ in Saudi Arabia. Key features of the RHQ regime are as follows: a nil corporate tax on RHQ profits, and be nil withholding tax on payments to related and third parties, subject to conditions. Kindly subscribe to our channel, email your queries to fast@taxlazy.com, and visit us at taxlazy.com. Thanks for watching.